Good morning, everybody. Mike Vaki, Princetontrader.com, here for ntmarkets.com with your Tuesday morning pre-market webcast. Okay, daily chart of the ES, and you can just see these Bollinger Bands continue to get tighter. The actual bandwidth has dropped below 2. So we're going to get a big move here. And the way the market is trading, you had an almost touch the band here, and then we're just gliding along the middle band of the 20-day simple moving average. And now we're starting to come up off of that. So, I mean, it's an either or kind of a thing. Either we're getting ready to do another upper band ride, and with the tightness of the bands, that could last a period of days, or we're in for a pretty big head fake. I think it's much more likely, based upon the uptrend and the way this market's been acting for a period of years, that we're getting ready to go on another upper band ride. It's very similar to this area here where the bands were about as tight. The 50-day exponential moving average was acting as the base, and then we just lifted. Right now, we have the 20-day acting as the base, and it wants to lift. So we did it for 3 days here, lifted up. We've done it now for another 3 days, and yesterday we didn't even challenge the middle band. We didn't challenge the prior day low. If you're a bear, you want to see the 48 get taken out today. That was yesterday's low. That's your first indication that the bears have life, and could maybe push it back down into the 44, 42 area of that middle band, and maybe turn this around and turn this into a head fake that could turn into a lower band ride. But that's definitely a lower percentage outcome. So on the upside, at this point, we're trading 57 quarter. Right now you have 1960 in sight. I told my subscribers last week that, once we breach some of these cash areas that people have been looking at, that really 1960 on the futures didn't have a chance. And that will probably fall today. If 1960 doesn't fall today, then that would be an indication that the bulls are starting to get a little bit tired, that they don't have enough to take it up to new highs, and that could create enough momentum for the bears. It's very hard to say. The bears are very unpredictable, but what I do know is this: any dip in this market right now, whether it's a 3-handle dip, 7-handle dip, or a 10-handle dip, is a buy. It's a buy because the bears cannot turn that dip into a lower high and a lower low. They haven't done it in weeks. Will they do it again at some point? Yes. But that's why you use stops. So that the one time that they finally do find their car keys and get it done, you control your loss. But for now, every dip in this market has to be treated as a buy. And whether that's here's yesterday. We do 40, 48 in the pre, and then we keep making higher lows. Dips a buy, dips a buy, dips a buy. These are buys. These are all areas that we were identifying. These areas are buys. And just when you think it can't go back up again, we're right back up at 55s. Now we're trading 57.5. So it was definitely, and you can see with these dips, it was a much more two-sided market yesterday. And I've been thinking two-sided market now, at least for the summer, for a little bit. I mean, definitely with an upward tilt, but two-sided nonetheless, and that's fine. You can't trade a two-sided market unless you let go of any bias that you have with respect to what the market, quote unquote, should be doing, and any ideologies about whether you're a bull or a bear. You just need to trade. So we'll talk about that more as we go forward. But for now, we got the slow grind higher to 1960. Everybody have a fantastic day. Follow us on Twitter at Princetontrader. Come check out the website. Come check out the chat room. Come check out Hammerstone. A lot of great things going on there. I will be back tomorrow morning with another webcast. Trade them well, everybody.